Okay, welcome to your first FRK 300 live lecture for 2021. I hope you're going to enjoy it. I'm most certainly am going to enjoy it, regardless of whether you do or not. So yeah, let's get started. So first of all, on the screen there you'll see my contact information. So you can contact me on my personal email address, not my personal address, the work address. And then we also have the FRK 300 mailbox, which is manned by all of the lecturers and the academic trainee. And is the discussion boards. So there you'll be able to, if you have a specific question on, say, for example, the homework of yesterday, question 1, part A and B, then you can just go and check there if someone hasn't perhaps already asked your question and get your answer from that. And also you're welcome if someone asks a question and you think you know the answer, you're welcome to try and help your fellow students as well. Okay, so let's get started. I must say I was very disappointed yesterday when I learned that I was not going to see your faces in front of me in class today. However, I improvised. So I will be imagining myself that I'm seeing all of you in front of me, and you will be represented by Stu. Okay, this is Stu Dent. He's going to sit here in class representing you guys. So yes, I will just make sure that Stu Dent follows and knows what's going on. Okay, so Stu, are you ready? Can we start? Okay, cool. Okay, so it's always very intimidating to me to have to stand in front of a class of BCom Accounting Sciences third-year students because, you know, now you're still a student, which is basically means you're nothing. But in 10, 15 years from now, 20 years from now, we definitely have future CEOs, future CFOs, future entrepreneurs, Stu, in our class, in this class, in this group. So effectively, I am standing in front of these very important people. It's just a little bit of a time until we get there. So that's quite intimidating. But that's fine. I've been doing it for a while, so I will survive. So please just be kind on me, the lecturer, knowing that you are you are going to be this powerful and responsible person in future. Okay, so yes. So that might probably be you in a few years' time, or Stu, as a representative of you. So maybe one day we'll be seeing you on magazine covers and reading about you in a good way. Yeah, like I said, it's quite intimidating to stand here in front of you. On that, we get from SAICA, we get an email from SAICA every time there's a disciplinary hearing of a SAICA member, and I always quickly go and check whether this person was a University of Pretoria student. So please don't let me have to check. Don't let me get an email like that of you from SAICA, so that I have to check and see, oh gosh, this person wasn't in my class in 2021. Please, I don't want to do that. Okay. So first of all, before we start with deferred accounting, let me just tell you that accounting is a lie. Yes, I know you're studying accounting, but in effect, accounting is a lie. Why am I saying this? Well, the same thing goes for art. So this is a quote by the famous artist Pablo Picasso, who said that we all know that art is not truth. Art is a lie that makes us realize the truth, at least the truth that is given us to understand. So in a sense, art and accounting is the same thing. As an artist gives a representation of reality, and puts that into a way to communicate this reality to whoever's looking at that painting. And we are doing the same as accountants. We are taking the truth of an organization, and we are putting it into information. Show you the picture. Oops, no. We're putting it into information, and then we are giving it to people so they can use it to make decisions. So Pablo Picasso knew what he was talking about when he said that art is a lie. Because if you think about it, let me show you. This was, I think the name was Donna Maar or something like She was one of his muses that he painted regularly. So that's a picture of her. So it's also not the real reality, it's just a picture of her. But let me show you what Picasso's interpretation or Picasso's account of that reality was. So when Picasso said art is a lie, he knew what he was talking about. Okay, and in my personal experience, I also have an example of this. My grandmother has this picture of me that someone drew for her when I was little, and she still has it on her bedroom wall. And I promise you that art is a lie. I never looked like that. My hair was never that demacor. But anyway, she thinks it's beautiful and she still looks at it every day. So art is definitely a lie. So when we get to accounting, then we see that, as I said, we as accountants have to take truth, convert it into information so that others can get a knowledge of that truth. So you guys will be the ones who are responsible for doing this, communicating truth through the financial statements, so that the people who make decisions on this can make the right decisions. So you have to realize the importance of what you are doing. Realize how important it is what you are doing. You have all these people making decisions based on the information that you produce. You have this responsibility. You cannot be providing them with information where you actually don't really, I can't remember IFRS 16 that well, so I'm not sure how to communicate this. What should the journals look like? You cannot operate like this if you have all these people relying on the information that you provide. Okay, so it's people's pension plans, it's their savings that they're saving up for their children to go and study or whatever. So it's a big responsibility that you have to provide them with the right information. So in my position here, or in our position at the FRK Lecturers, we are here to provide you with one of the most important qualities that you need, most important attributes that you need to be able to fulfill this responsibility to all these people. And that attribute is, a warm, fuzzy feeling. Okay, you need to have a warm, fuzzy feeling. Okay, so what is a warm, fuzzy feeling? The definition I got just by quickly Googling it said it's a feeling of comfort, sort of like the feeling one gets from a warm, soft blanket. Usually a feeling one gets when one embraces the familiar. Oh, so nice, embraces the familiar, warm, soft blanket. And it's the opposite of fear, uncertainty, and doubt. Okay, so look at these pictures and then feel whether you are getting a warm, fuzzy feeling or whether you are getting fear, uncertainty, and doubt. Okay, so that picture, what does that give you? Tell me, what does that give you? Through you in the comment section. Warm, fuzzy feeling or fear, uncertainty, and doubt? Allergies. Oh, never mind. We are going to just ignore you, Mr. Duplessis, because warm, fuzzy, no, not scary. All the Duplessis have issues with cats, it seems. You don't have to touch the cat, but you have to agree it's warm and fuzzy. Cool. Okay, what do you get when you look at this picture? What feeling do you get? Three of you. Nothing. Now the Duplessis are going to say, warm, fuzzy feeling. Okay. ICF, okay, no man. Okay, next one. What do you get when you look at that picture? Okay, hopefully you're thinking back to when you were little and you remember SpongeBob and Patrick, and you get that warm, fuzzy feeling. Okay? What do you get when you look at this one? Do you know who that is? Do you know who that is? Professor Oberholster? Wisdom. Ooh, anxiety, yes. So do you get this, do you feel the difference between warm, fuzzy feeling and fear, uncertainty, and doubt? Okay, so I want you to look, when you look at your red books, your red IFRS books, I want you to feel that warm, fuzzy feeling. Okay, you cannot afford to feel any fear, uncertainty, and doubt. Because remember about all those people who are dependent on you. Okay, so you have to have that warm, fuzzy, soft blanket, familiar feeling when you look at your IFRS textbooks. Okay, no, not back pain. Okay, and don't stress, make it your friend, embrace it, warm and familiar. Okay, so you have to make sure after every topic that you get that warm, fuzzy feeling. Okay, so it's not, warm, fuzzy feeling does not just come from memorizing whatever it is you need to do. Warm, fuzzy feeling comes from understanding what you are doing and why you're doing it. Okay. So, I don't know if you guys saw that, what was the movie's name? Despicable Me, that little girl who says, it's so fluffy. So, I want you to feel like that about standards. So, I did it. All of your lecturers, or most of your lecturers are CAs. We all did it. And you can do this. Nothing that makes you different from us. When I was a third-year student 7 years ago, I was able to do this and to pass FRK 300 and FPS 300. Okay, so you can do it too. Okay, there's no difference between us. I just have a few more years. You've got what it takes. Think back to when you got your matric results. When was that? It would have been in 1990. You were matric in 1998, if I remember correctly. No, sorry. 2018, you were matric. So 2019, you got your matric results. So think about that feeling when you got that. You are all strong students. You all did very well at school. You are not 50, 52 students. You are distinction students. So what went wrong between your matric results and now? Okay, there's no reason why you can't still be a distinction student. You are a distinction student. You just have to live up to that potential that you have. And you've got it. You've got it inside of you. It's just now having the commitment to do it and to get those marks. Okay. Okay, so before we start with deferred tax, just some quick admin. Most of you did the current tax test. I saw this morning at 5 o'clock, some of you were still busy with it, which is good. I'm glad to see that commitment so in the morning. But there were still some of you who didn't do it. I hope you all got to it. And when you did that test, did it 7, 8 times, when you got that 100%, did you get that warm, fuzzy feeling? Was it good to get 100% for a test again? Because you did it at school. I know you got 100% for quite a few tests at school. Was it nice to get it again? Yes. And you can do that. Okay, so you just have to make sure that you understand what you are doing. Don't memorize it, understand it, see it, get that warm, fuzzy feeling. Okay. And then lastly, last thing I want to quickly mention to you is the class reps. There's a survey on ClickUp where you can go and nominate someone or yourself for class rep, and then we'll take the process from there to select our class rep. So we'll communicate that to you probably towards the end of the week, what our process is going to be, and then we'll have some class reps next week. Good. Okay, warm, fuzzy feeling after a few attempts. I'm glad to hear that. Now we start with the serious stuff. Although actually what I said before was the serious stuff. Now we just start to work towards that warm, fuzzy feeling. Okay, so we're looking at what is deferred tax. Now remember I told you that somewhere in all the documents or videos, I can't remember where I said this, but FRK 300 is mostly about 2 topics. Let's make it 3 topics. 3 big topics. The first one is IAS 12 and deferred tax, because you're going to see this topic, you're going to see deferred tax in all of your other topics throughout the year. Okay, except for one topic, which is the second, which was a second one of the 3 most important or 3 big topics, and that's financial instruments. So if you understand deferred tax, you understand financial instruments, And you understand, lastly, your group statements, which incorporate then deferred tax and financial instruments and all of that. Then FRK 300 is going to be a breeze. Okay, so make sure you follow and make sure you get that warm fuzzy feeling about deferred tax before we move on to the next topics. So what is deferred tax? Okay, so first of all, before we talk about deferred tax, let's quickly think about a normal accrued expense. So what is an accrued expense? That is where we buy something now, but we only pay for it later. So we get the benefit of whatever it is that we purchased now, but we only pay for it in future. So let's say benefit now, pay later. Okay, so that's an accrued expense. Do you agree with that? Some thumbs up. Somewhere you can give me thumbs up. I don't know where. You guys probably know Blackboard better than me, but okay, do you agree with me that an accrued expense is something where you get a benefit now and you only have to pay for it later? Okay, I suppose you all agree. So yes, cool. So an accrued expense, therefore, is a liability. If we think about the definition of a liability, it's a present obligation to transfer an economic resource, so that's the pay later, as a result of a past event. So that's a benefit that we got now. So that accrued expense is a liability because we are going to have to pay later as a result of a past event where we got the benefit. Okay, so remember that. We get the benefit now, but we have to pay later. So we have this liability. Now, if we go back to that example, just the example we did in the videos that you had to watch yesterday, just one of those transactions in that example, regard to the plant, where we say we purchased the plant for 700,000, depreciation is calculated at 10% per annum straight line, and wear and tear allowance over 7 years. So let's just look at this transaction. Okay, so what we did in our current tax calculation, we said that we start with our accounting profit, then we have to add back the depreciation, because remember, the depreciation was included in, so let me just get my pointer. The depreciation was included in the accounting profit, so we have to add it back. Depreciation was deducted to get to this amount, so we have to add it back to eliminate. And then we have to deduct the wear and tear. Okay, and then in the end, we actually effectively, the difference between these two amounts is that we are getting a benefit in year one, a tax benefit, because we are paying tax on an amount that is lower than our original accounting profit. Okay, so we are going to have to do this calculation for the entire period that we have this asset and that we have depreciation, that we have wear and tear. So every year we are going to have to do this. So our depreciation over 10 years and our wear and tear allowances over 7 years. So if we now do this calculation again in year 2, it's going to look exactly the same. Year 3, 4, 5, 6, 7 looks the same all through year 7. However, now after year 7, we have used up all of our wear and tear allowances. We've already now had our 700,000 wear and tear allowances. So for year 8, 9, and 10, we are only going to add back the depreciation to get to taxable income. Okay. But in the end, and this is a very important concept to understand, is that in the end, after these 10 years, the net effect between the tax and the accounting treatment will be 0. So there's actually just a little bit of a timing difference between accounting and tax. After 10 years, we would have had to add back 700,000 depreciation, and we would have deducted 700,000 wear and tear. Okay, so the net effect over the 10 years is 0. However, now if we are, okay, so what happens here is for the first 7 years, we are going to be very happy because we are getting a tax saving every year. Okay, because every year our taxable profit is going to be 30,000 less than our accounting profit. So without having to do any additional transactions or sell any more inventory or whatever, we are getting this tax saving just because of these timing differences. However, in the next 3 years, we are going to be a bit sad, okay? Because in the next 3 years, we are actually going to have to pay tax on an amount that is higher than our accounting profit. Okay, Stu, do you get that? Do you understand what I'm saying? Okay, cool. So, if we are now here after year 1, at the end of year 1, we actually had a benefit in year 1 where we had this tax saving of 30,000 less taxable profit. However, what's going to happen in future? At the moment, we got this benefit of 28% on 30,000, so that's an 8,400 benefit that we got in year 1. However, in future, what's going to happen? In future, we are going to have tax savings for 6 years. Okay, so that those 6 years over there, we are going to have tax savings, which will be 6 years worth of 30,000 times 28%. But then in the next 3 years, we are going to have to pay additional tax. Okay, which will be 3 years, 70,000 each, 210,000 times 28%. So if we are standing at the end of year 1 and we just look at what's going to happen in future, we see that the net difference between these future benefits and the future payment actually gives us a net future payment of 8,400. Okay, so that's our pay later amount. So we got a benefit now, but because this is just a timing difference, somewhere in future, it's going to swing around and turn around, and we're going to have to pay for it later. Okay, so if we think back to the definition or to what was said about an accrued expense, the fact that we're getting a benefit now, but we have to pay for it later, do you agree that this 8,400 future payment looks very much like a liability? Can you see that? Okay. And that is it's exactly what it is. It is our deferred tax liability. So we are deferring this tax payment. It's going to happen, but it's only going to happen in future. But we got the benefit for that in the current year. Okay, so that's our deferred tax liability. Does that make sense? Are you following me? Quickly see. Why won't it be 1? Why won't it be 1? Mr. Duplessis, you still have that question? Okay. Okay, seems you're getting it. Mr. Duplessis, I'm not exactly sure I understand your question there, but we can get to it later. Maybe I'll answer it. I mean, the depreciation can't fully depreciate the
Ja.
Sound now on. Okay, cool. I think if we get 15 yeses, that's enough. Okay. Sorry about that. I don't know what happened. Blackboard just took me out. Okay, so we are going to, this is recorded, so you're welcome to sleep in late. I see you saying you prefer pre-recorded lectures, and then you can just watch it later if you want to. Okay, cool. Let me just pick up where I was. Okay, so I convinced you all that we have a liability at the end of year one with regard to full deferred tax. Okay, so that means at the end of year one, when we do our financial statements, you will see that we now have a property, plant and equipment with a carrying amount of 630,000, which will be the 700,000 cost less the first year's depreciation, 630. However, okay, and this carrying amount is an asset, and if we look at the definition of an asset, it says it's a present economic resource that's controlled as a result of past events. And this economic resource gives us a right that has the potential to produce economic benefits. So in essence, that 630,000 carrying amount of the asset is a promise. It is a promise to say that as we use this plant in future, we will at least get 630,000 economic benefits from this asset. So that's what the carrying amount represents. It says at least the amount that we get in future from this will be 630,000. Okay, so we're going to get these economic benefits. Now, for the same plant, from the tax perspective, it has a tax carrying amount of 600,000. So that's the tax base. You know about tax base. You've heard about it before. So in BEL 200. So the carrying or the original cost 700,000 less the first year's wear and tear gives us then a 600,000 tax base, which is going to be the future wear and tear allowances that we can deduct against these economic benefits that we are going to get in future. Okay, so in future we are going to have to pay tax on these economic benefits. So when we get the 630,000, which is the promise that we are making that we are going to get in future, times 28%, it gives us our tax that we are going to have to pay in future from this plant. But we will be able to deduct remaining wear and tear allowances against that. And that's the tax base of the asset times 28%. So we'll be able to deduct this amount from these future economic benefits. So the difference between these two is our deferred tax liability. Okay, so there we put our deferred tax liability under current liabilities in our statement of financial position. Okay, so and if we look at the definition of a liability, we see that this deferred tax is a liability because in future we are going to have to pay this additional tax amount. So it will be a transfer of economic resource as a result of a past event. Okay, so how do we for deferred tax. We now know that we needed this liability, so we know that we need to credit deferred tax in the statement of position. What do we debit? We are going to debit the income tax expense, okay, in our profit or loss. Now you know about the income tax expense. If we look at the note for the income tax expense, you already know about the current tax for the current year, over or under provision of current tax for prior year, and we also discussed foreign withholding tax in the videos of yesterday. So this new debit that we have here for deferred tax is then an additional line item that goes to my income tax expense, and that is the origination and reversal of temporary differences. Okay, so in our income tax expense, we don't only have current tax, we also have foreign withholding tax as well as deferred tax. So that's how we account for deferred tax. We create the balance and then we put the debit to our P&L. Okay, now let's look at another section of that example and see if we can apply that to, we can see if deferred tax applies to that. So in that example we did in yesterday's videos, we also had a dividend income of 10,000 Rand. So what happened in our current tax calculation? We had to deduct the dividend income, and because it's not taxable, we will account for it as an income for accounting purposes, but not for tax purposes. So that gave us a tax saving. So that gave us a benefit in the first year. However, if we now look forward to year 2, 3, 4, 5, 6, up to year 1000, can you see that this benefit is never going to swing around? We are never going to have a pay later. Does this sound bad? Okay. Okay, it's fine for me. Some say it's fine. I'll just speak louder. Okay. Hendrik is just checking. Okay, back. Is it better now? Perfect. Yes, it's back. Okay, cool. So if we get to our example here, can you see that we are never going to have to pay later? We got the benefit in year 1 of having a tax saving, but it's never going to how long we carry on. That specific benefit that we got for dividend income in year 1 is not a timing difference. It's not a temporary difference. It's never going to, we're never going to get a situation where the tax, the accounting treatment is the same. So therefore, we do not have a liability with regard to these type of adjustments that we need to make to our accounting profit. Okay, so see the difference. See that we have temporary differences, that over time the accounting and the tax will be the same, and we have other adjustments that we need to make that are non-temporary differences. They are actually permanent differences because they're never going to swing around. So for these type of adjustments, we are never going to have a deferred tax. Okay. So if we go back to our full example that in yesterday's videos, there's our current tax calc. We had to deduct the dividend income and add back the fines. So the same dividend income fines are in the same category. The accounting and the tax will never be the same. So not a temporary difference, it's actually a permanent difference. So this will not fix any of this with deferred tax. However, we've now seen that for depreciation and wear and tear, we can fix it with deferred tax. And we did that journal to say debit the income tax expense, credit the deferred tax liability in the SFP. Good, so in our splokkie, what do we have now? We have our accounting profit, and then we have our income tax expense, which consists of the 26,000 that we calculated over here, add the 8,004 debt we accounted for with our deferred tax. Now, what I want you to see, make sure you get the warm fuzzy feeling now. I want you to be able to see that, oops, the SFP, see the SFP, okay? But I want you to see that this adjustment that we made in the current tax calc for depreciation and wear and tear, do you agree that that actually effectively decreased the income tax, the current tax expense? Okay, because we decreased that current tax expense. However, so that was the benefit that we got. But then for accounting purposes, we said, right, hold on, we got a benefit now, but in future, it's going to swing around. So we're actually going to have to pay for it later. And because we're doing accrual accounting, we said, no, that payment that's going to come in future, we raise a liability for that. So, and that is our cumulative temporary differences. It's the difference between our carrying amount of the asset for accounting purposes and our tax base. Gives us then this 30,000 difference. Times 28% is the 8,400, which is then the liability over here that we raised for deferred tax. And then we also, the debit went to income tax expense. So that debit then again increase the income tax expense. Okay, so effectively the temporary differences then net to zero. Can you see that what we did it because we are doing accrual accounting? We said, okay, we get the benefit over here. Yes, our current tax expense is lower. However, we are going to pay for it in future, so we are now increasing it again with our deferred tax journal. Okay, so we are effectively eliminating the effect of the temporary differences for accounting purposes. This is still the calc we do for tax purposes. This is still the amount we have to pay to SARS. SARS doesn't care and doesn't worry about deferred tax. SARS knows he's going to get his due, or he or she. Will SARS be male or female? Okay. Suppose a bit evil, so probably female. So SARS knows that she will get what's due to her in future. So she's not worried about deferred tax. So this journal we purely do for accounting purposes to say, okay, the effect of these temporary differences we want to eliminate. Okay, so we are doing accrual accounting. Now you'll see that we didn't do anything for the dividend income and the fines. And that is because these are not temporary differences. Okay. So no temporary, it's non-temporary differences and therefore no deferred tax. Yeah, saw a hand, but it's gone now. Okay. So if we now look at, a good question, will the deferred tax liability in year 2 be 16,800? Let's quickly go back over here. So what's going to happen in year 2 is we are going to have, our carrying amount will now be 630,000 less 70,000. So what is that going to be? 560, yes, okay. 560, okay. So our carrying amount is going to be 560 and our tax base is going to be 500,000, okay. So the difference will be between 560 and 500,000 will be 60,000. So our cumulative future later tax amount will be 60,000 times. Can you see that this liability is just going to increase every year? So at the end of year 1, the liability was 30,000 times 28%. Now, okay, let's go back to that slide. Quickly. Okay, so at the end of year 2, we now had a benefit of 60,000, but in future, if we add all these together, from year 3 to year 10, you'll see that we are going to have to pay 60,000 later in tax as well. So at the end of year 2, our deferred tax liability will now increase to, was it 16,800? So Yes, so 16,800. So, yeah, you are correct. Okay, Mr. De Jager, you are correct. Okay, so that means we are just going to do that same journal again to increase that deferred tax liability to 16,800. Good. Now we'll continue calculating that deferred tax until the end, until that asset is not on our, we're not using that asset anymore, until the asset is gone. Because as long as the asset has a carrying amount, that's a promise of future economic benefits, and we compare that to the tax base, and the difference between these two will give us our deferred tax. So we will continue doing this calculation in year 8 as well. What's going to happen in, so up until year 7, this tax liability is going to grow with 8,400, 8,400, every year 8,400. So remember that benefit was 30,000, 30,000, 30,000, 30,000. But then after year 7, now it's going to go down. It's going to go down with 100,000, 100,000, 100,000. So in the end, you'll see that the deferred tax liability goes up, and then all of a sudden starts dropping down. And then at the end of year 10, when the asset does not have the carrying amount anymore, no tax base, the deferred tax liability will be 0. Okay. Good. So where were we? Okay, we'll get to that. I'll see a question that we are going to get to. Okay, before we get to the questions, let's quickly just look at something I want to show you with regard to this current tax calc and the difference between the temporary difference and non-temporary differences. Okay, so if we, you guys know, those of you who had accounting at school, you know that what did we do at school? At school, we took our accounting profit, that 470,000 over there, our profit before tax, and we just multiplied that by 28%, and that was our income tax expense. However, if we now look at what we have in our splokkie, we see that our actual income tax expense is now different. Okay, so this is maybe someone who did have accounting at school, and a user outside there, one of those people that you are accounting for, that you are giving the financial statements for, they're thinking, yeah, but why isn't it 28? Why if I take this and I divide it by the profit before tax, why am I not getting 28%? Why is there a difference? Okay, why is the effective tax rate, that's the income tax expense divided by the profit before tax, why is it 28.6 and not 28%? And the reason for that difference is due to our non-temporary differences. So you'll see if we take the tax on the accounting profit, so just the accounting profit multiplied by 28%, the 131,600, and we say, okay, but remember we had dividend income that was exempt, so we didn't so the dividend income is included in the accounting profit, so it would be included in this calculation. But dividend income is not taxable, so the tax effect of that we eliminate, we take out. And then we have the same situation with fines, but just the other way around, because now that is an expense for accounting purposes, but we are not taxed, or we can deduct it for tax purposes, so we have to add the tax effect back. Can you see that we are now getting to the 134,400, which is our income tax expense on our splokkie? Okay, so these non-temporary differences cause our effective tax rate to be different to just normal plain straight sailing 28%. Okay, so even though these temporary differences also affected our current tax that we had to pay, we said, okay, we got a saving now, but we're going to have to pay in future, so therefore we are reversing that saving, we are accruing for that expense that's going to happen in future, and we eliminated that 8,400 benefit with our deferred tax journal. Okay, so it's only my non-temporary differences that cause this difference between accounting profit at 28% and our actual income tax expense. Okay. 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 Now I see a question there for tax assets. Now I'm going to get to that question. Up to now, we've had the situation where our depreciation was calculated at 10%, so that was 10 years. What if we change it to 25%? So that means that for accounting purposes, we are going to have depreciation for 4 years, but for tax purposes, we are going to have a wear and tear allowance for 7 years. So then what's going to happen is in year 1, 2, 3, and 4, we are going to have to add back the depreciation. And then for years 1 to 7, we are going to deduct the wear and tear in our current tax calculation. Remember, this is not on a splokkie or anything, it's a calculation. So over time, after the 7 years, we would have added back the full 700,000 depreciation and deducted the full 700,000 as wear and tear. Okay, so the same situation we had with the 10% depreciation. The difference now is that now we are getting a benefit for year 1, 2, 3, and 4. So we are not paying now, we're getting the benefit now. And then we are actually, so those two must be the other way around, sorry. Okay, so ignore this. Okay, so we are actually getting a benefit for the first 4 years, and then we have to pay no, you are right. Sorry. Oh, I was right. Yeah, okay, never mind. Okay, anyway. Right, so we are paying now and we're getting a benefit because we are increasing our taxable profit. We are paying tax on an amount higher than our accounting profit. So we're doing that for the first 4 years. So we are paying, that's a P, we are paying the first 4 years and then we are getting a benefit in the next 3 years. Okay, so that means that after year 1, we now paid additional tax in year 1, so we had to pay that additional tax, but in future we are going to get a benefit. So after year 1, our additional tax payment was 21,000, so the 75,000 times 28%. Our carrying amount of the asset will be 525,000. Our tax base will be 600,000. So the net difference is a 21,000 future benefit. Net difference between these two amounts times the tax rate is a 21,000 future benefit, okay, that we are going to get for tax purposes. So that is then a deferred taxes. Okay, so we're paying, yeah, you're right, Ms. Dancer. So we're paying more tax. I was wrong. So we are paying now, and then we're getting. Okay, so at the end of year 1, because we've paid some of that additional tax in year 1, but overall in the future we are going to get a benefit, and that gives us then our deferred tax asset. Good. So the journal will just be the other way around. We're going to debit deferred tax, create this deferred tax asset, credit the income tax expense. And what's going to happen now is that we are going to do that, sorry, the amounts will just be different, but we're going to do for these first 4 years, and then it's going to swing around up until where it's 0. Okay. So the deferred tax asset is going to increase, 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 and then it's going to decrease, decrease, decrease until it's 0. Okay, so just quickly summary, what is deferred tax? We say that deferred tax is the current tax of the future. It's an accounting item. SARS does not worry about what journals we do for deferred tax. SARS just worries about that yellow current tax calculation of ours. SARS does not worry about any deferred tax. That's something that we do for accounting purposes because we are accruing for these future tax benefits or future tax payments. Okay, we only use deferred tax when over time the cumulative accounting and tax treatment will be the same. So if we look at the end of the 10 years, we saw that for accounting purposes we would have had to add back the depreciation of 700,000, and for tax purposes we deducted 700,000 wear and tear. Net effect was 0. So over time the tax and the accounting is the same. And then we fix those temporary differences between accounting and tax with our deferred tax. Okay, but only for our temporary differences. Okay. So the tax is driven by the statement of financial position, the difference between carrying amount and the tax base. And if we have a situation where the tax rate in profit and loss is always equal to the actual tax rate, that is because of our non-temporary differences. Okay, so deferred tax accounts for the future tax effects, but only for my temporary differences. And so therefore it fixes the effective tax rate again so that it's the same as the actual tax rate. However, if we have non-temporary differences, the effective tax rate will not be the same than the actual tax rate. Okay, so how do we calculate deferred tax? So as we said, deferred tax is driven by the statement of financial position. So therefore, what we do to calculate deferred tax is we do a calculation where we list all of our assets and liabilities from our statement of financial position, the left-hand side in this column. And then for each asset liability, we put in our carrying amount from the SFP. Okay, or we don't usually have, we won't put PPE here, we'll break it up into the different assets, but more detail, just the SFP. So we list the carrying amounts, and then for each of these, we calculate what the tax base is, and then the difference between the two gives us our cumulative future temporary differences. Okay, so because this is the difference between the promise of economic benefits in the future that we'll have to pay tax on, versus the future wear and tear deductions that we are going to get. So that gives us then a 30,000 temporary difference. And the tax on that is 8,400. We multiply this column, the temporary difference, with the 28%, and that gives us our deferred tax liability. Okay. So you'll also, so these cumulative temporary differences is our SFP balance. This 8,400 will be our SFP balance. And the movement from last year's deferred tax to the current year's deferred tax will be our SPLOCkie expense. So sometimes you'll see in our notes, sometimes the questions, there's an additional column that says movement to the SPLOCkie. So that's the movement from the opening balance to the closing balance. Okay, what's going to happen in year 2? I'll get to some of your questions then just now. So in year 2, now the plant's carrying amount will be lower because we had a second year's worth of depreciation. The tax base is also lower because we had a second year wear and tear. The difference is 60,000. Multiply that by 28% gives me 16,800 liability. So this should be our closing balance of our deferred tax account. So what we're calculating in this column is our closing balance. So we know that our opening balance was 8,400. Our closing balance should be 16,800. Therefore, we will have to debit the income tax expense in the SPLOCkie and credit the deferred tax in the SFB to move from 8,400 to 16,800. Okay, so let's get to some of your questions. So the deferred tax liability will increase by the original. Okay, I think I answered that. Okay, now I've answered Mr. Schmidt. I've answered your question as well. Okay, we spoke about the deferred tax asset. Okay, I'll upload the slides before the lecture is difficult because I literally was still working on my slides until 9:05, but I'll see what I can do for you. Maybe I can just give you like the broad outline of the slides. I can do that. Okay, can we say in layman terms that a deferred tax asset is almost like an income received in advance? If it's income received in advance, yes. So then what it means is we have received a benefit today. No, we've made a payment today. it's actually like a prepayment. Let's think about it rather as a prepayment, as income received in advance. So we've made a payment, additional payment of tax now, but we are going to get the benefit later. So it's more like a prepaid expense, if you want to compare that that way. Or depreciation or wear and tear, your own cumulative temporary differences? No. You'll see when we get to it's a Thursday's lecture. Like I said, we actually do this for all our assets and liabilities. Okay, so the depreciation wear and tear is just an easy way to explain why we have deferred tax. But we actually do that for all our assets and liabilities. Is deferred tax a current liability? Yes. Okay. Why is that? Why do we say it's actually a non-current liability? What did I put it as? Just double check myself. Quickly go back. Ooh. The thing is, because you write that this 8,400 is now only going to swing around in what, 7-8 years time. However, remember, we are not going to have only a plant. We are actually going to have all kinds of other assets as well. So it will be difficult to determine what portion of that deferred tax is current and what portion of that deferred tax is non-current. Okay, so therefore we just treat all the deferred tax liabilities as we put it all into one balance, and then we put it as I think as a current liability on our SFP. Okay, so where are we now? Deferred tax. Okay, we've answered that one. Okay. Now missing. Can I just confirm we don't pay for deferred tax now? We pay current tax now, but simply record the deferred tax along with the current tax to show the future tax to be paid. Yes, so that's what current tax is, the tax that we have to pay now. So that's the 126,000 that we have to pay now. However, this temporary difference, this timing difference, this benefit that we got over here creates a deferred tax liability in future that we account for with deferred tax. So we, like I said, SARS does not worry about, doesn't even look at our deferred tax journals. Okay. To show the future tax to be paid, yes. So we're actually just showing the future tax effect of this asset that we still have on our equity. Okay, so we're saying when we get these benefits that we are promising to the users, we are going to have to in future pay more tax than what the benefits are we are going to get from the asset. How long will it take for you to upload this lecture? Well, Blackboard Collaborate does that automatically, but it takes a while because it's quite a long lecture. But I don't know, maybe half an hour. Maybe you should just check in half an hour. So it's something that is automatically. Yeah. So I'm not sure. We'll check. This is my first live lecture, so I'll be learning. Mr. Andre, the last question, what are the tax rate changes during the period in which the deferred tax is calculated over the 4 years, for example? Okay, we're going to get to that. Okay, obviously, when you qualify as a CA, they send you your certificate, and together with your certificate in the mail, you get a beautiful crystal ball. Did you know that? Did you know that you get a crystal ball from SAICA when you qualify? Because we have to look into this crystal ball to make predictions about the future. So we have to say, with regard to this property, plant, and equipment, we have to predict to say, how long do we think we are going to use this asset for? And we predicted, we looked into the ball, and it said 7 years. Okay, so cool, we're going to use, or 10 years, we're going to use this asset for 10 years. And based on that, we calculated our depreciation. Now, if we think that maybe in future the tax rate is going to change, we don't know that yet. So therefore, we'll get to that when the tax rate changes. We'll use the applicable tax rate that we have to use at year end to calculate all of our future deferred tax. Okay, so we're not going to sit there and look into our ball and ask, okay, when is the tax rate going to change? And how much will it be? crystal ball does not give us that information. So we just use the tax rate that we have to use at year end, but we get into an example later with our lectures. Not sure if it's on Thursday, but that tells us what we should do when the tax rate changes. Okay, do we do deferred tax because of the accrual principle? Exactly, that's 100%, that's why we do it. Because we are using accrual accounting, we are saying, okay, we got the benefit now, but remember the same is going to happen in future, so we actually have a liability that we have to account for now. Okay, so that's exactly what we are doing. Okay, any other questions? Okay, just one quick, just a moment. I see Dr. Barden has just walked in. Yes, you are here. For me, deferred taxes, we show as a current tax liability. Or non-current. Oops, sorry, it's non-current, okay? So I have it wrong here on my slides. You're welcome to write an email to the head of the department. So this will be a non-current liability, okay? Non-current, okay, it will always be non-current. I thought that when I saw this, it confused me, but anyway. So it will always be non-current because we don't know what portion of it is current and what portion. We can calculate it, but it's going to be intense to do that. It's not going to give more information to the users. Okay, Mr. Holt, another question. So the deferred tax balance will clear itself, not by us paying it off as we would current tax, but by the temporary differences balance each other out throughout the asset's useful life. 100%. Okay, so we are never going to refer to our deferred tax calc to determine what our current tax amount should be that we are paying to the receiver. We only do this calculation. Okay, let me just give my pointer. We only do this calculation to calculate what it is that we have to pay for current tax. Deferred tax calculation, you'll see, we just use that little formula with the columns. We take our carrying amount, less our tax base, and gives us the temporary differences to calculate what our deferred tax balance should be. Okay, so that we never use that to calculate what the physical amount is that we have to pay to SASH. Yes, Mr. Armstrong, Mr. Duplessis asked a question that I missed. Okay. Ms. Longworth, please could you explain the journal entry amounts during the second year, especially when looking at the movement? Okay, that is, messed up there. Good. Okay, so what will the journal be? Oh, okay, let's quickly see. I don't know if it's going to work. No, never mind. Okay, so what we have at the moment is I'm going to try and draw with my mouse. So at the beginning of year 2, this is our deferred tax SFP account. Okay, so this is our deferred tax, and in this case, it's a liability account. So we, at the moment, from year 1, we had a credit balance in here of 8,400. Okay. Now in year 2, oh gosh, one day when I'm big, I'm going to have a fancy iPad. Okay, one of you, if your dad works for Apple, remember me, because then I can just write on the iPad. Never mind. Okay, okay, I'm making a joke. Please don't send me iPads. Then I have to do a lot of explaining. Chocolates is fine. Chocolates, those thin slabs, they can slid under my door. That's fine. But iPads and yeah, okay, good. So now we've calculated in year 2 that this is what our closing balance should be. So what do we do? What's our journal going to be in year 2? Year 2, we are going to have to increase this deferred tax liability with another 8,400 in order to get to the 16,800. Okay, so now the balance in this account is 16,800, and the debit journal will just go to my income. Oh God, income tax expense. Okay, so there's the 8,400 on the debit side. 8400. 8400. Okay, you can read that. I'm sure you can. You're clever. Okay, so that's the journal. Okay. I hope I answered your question there, Ms. Longwood. Okay, I think honestly, if that happens, we would probably do IAS 8, so maybe change the opening balances when referring to the example, if the tax rate changes. Okay, yes, but let's not worry about that now. Let's worry about that when we get to IAS 8. Okay, when we look at the tax rate changes, and we'll worry about that when we get there. Okay. If the tax rate changes, it's not going to be IAS 8 because it's not a change in estimate. Remember, change in estimate. Sorry. Specifically excluded, yes. Okay, so yeah, so when there's a change in tax rate, it's not going to be an IAS 8 situation where we have to disclose that change. But it's because it's not our estimate based on the information that we had. It's not something that, yeah. But IAS 12 specifically says that when this tax rate change, it's not an IAS 8 change in estimate. Good. Well, changes in accounting principles. Oh, we are over our time. No, not yet. Will changes in accounting principles or estimates, like changes in useful life or models, have an effect on deferred tax? Yes, because the moment your carrying amount changes, your tax base will not change because of this change in accounting estimate. But if you now change your estimate regarding the depreciation of an asset, your tax base is going to change. Your carrying amount is going to change. Tax base stays the same, so therefore your deferred tax is going to change when you have that situation. Okay. Okay, so when you have that situation, then your deferred tax effect you will show that in your IAS 8. Changing tax rate in the coming lectures. Yes, thank you, Ms. van der Weyen. Well, that journal you've just done. So what's going to happen in years 8 to 10 is now, where is that picture? Now every time we do the calculation, you'll see that now our deferred tax balance is going to get smaller and smaller and smaller instead of increasing. Okay, so if we are now standing over here at the end of year 8, now we are going to say, okay, our carrying amount is this much and our tax base is this much. And now you'll see when you calculate what your deferred tax balance should be, you'll see that now it's lower than the balance that you had at the end of year 7. So that means we now have this big, credit balance at the moment, sitting there as a liability at the end of year 7. Now at the end of year 8, now we have a smaller credit balance than it should be. So to make a big credit balance smaller, we have to debit deferred tax in the SFP, and the other leg will be an income in income tax expense. Okay, so we just always calculate what should our closing balance be, and we adjust from our opening balance to our closing balance. Okay, that's Mr. Armstrong's question. I think we will do that later. Okay. Yeah. Income tax expense for year 2 change to or stay as, so the income tax expense itself will stay as 8,400, because remember, the 30,000 times 8,400 times 28% is 8,400. So what's going to happen is our deferred tax, in this case, our deferred tax liability at the end of year 1 is 8,400. Then it's going to increase. It's going to every year increase with 8,400, 8,400. So the movement to my income tax expense account will be 8,400 every year. But my SFP balance is going to grow with 8,400 up until the end of year 7, and then it's going to swing around to 0. Okay. What is the difference between temporary and non-temporary difference? The one is temporary and the other one is not temporary. So the non-temporary differences just means that it's not something that over time is going to net out to zero. So that's the example we had here with our with the dividend income. See, so the dividend income is a non-temporary difference because no, it's not going to ever in the future. Okay, it's never going to. We're never going to have to make an adjustment for tax purposes, so that in the end the total over here nets to zero. So that's a non-temporary difference. It is a difference. So we actually get differences and we get temporary differences. This is a permanent difference. It will always be there. Okay. Is the formal lecture finished and are you just doing questions now? Ms. Bailey, let me check the time. I think we have enough 5 minutes of our formal lecture time over, but yes, I've worked through all my slides. I'm answering your questions now. So any other questions that you have for me? We still have 5 minutes. I can tell you about what the campus looked like in the early 90s, if you are interested in that. Obviously not. So to confirm with non-temporary differences, we will not have deferred tax, 100%. There is nothing to fix with deferred tax. Deferred tax we can only use to fix our temporary differences, that we have a difference due to timing, but actually in the bigger sense, over time, the effect between accounting and tax is zero, it's the same. So for non-temporary differences, there is no deferred tax. Okay, we get this benefit over here in year one, and we're never going to have to pay for it in future. So there's no deferred tax. Okay. Any other questions? Okay, then I think that's it. If you, I apologize for the break we had earlier, but the lecture will be is recorded and will be available soon, and we will make sure that it doesn't happen again. And I saw some of your comments that you would actually prefer pre-recorded lectures. We will think about that and get back to you. But for now, this is the format that we are doing. So if you would like to just watch the recording, you can always do that afterwards. Okay, no, live is better. I like the live ones. Okay, so we obviously have different opinions, but luckily we cater for everyone. Okay, I see there's one more question. It is convenient to interact. I'm glad to hear that. Do we have to upload them somewhere? No, so the homework questions, there's one question, question 9, which does not have a solution in your question back. So that you are going to have to do as homework after your last lecture, and that you will upload for us on Clicker. The others you can just do every day as and when we complete the lecture. Okay, but please go and do them. I think there was a question. So at the end of 10 years, the deferred tax will be 0 and you no longer record it. Exactly, for this asset. But remember now, you will never have 0 assets. So you will have all kinds of other assets and liabilities and all kinds of things that will create deferred tax for us. So there will always be a deferred tax balance, well, most of the time. But yes, this asset of the balance will be 0. Okay. Why don't we have deferred tax for non-temporary differences? Because remember, that's exactly this picture that we have here at the moment. It's not, we can only, deferred tax, like I said, is like an accrued expense. We're getting a benefit, but we know in future we are going to have to pay more. And the reason why we are going to have to pay more is because the tax and the accounting is actually the same, 700,000, 700,000. But because of the timing difference, we were getting a benefit at the beginning of this asset's useful life, but later on it swung around and we had to start paying more tax. Okay, so for temporary differences, we are saying, oh, remember about this accrued expense in future. Remember that we are going to have to pay this tax in future. Whereas with dividend income, as we've seen over here, we get the benefit in year 1, but we are never going to have to pay the tax in future. Okay, so is no, and also dividend income, it doesn't give us an asset, it doesn't give us a promise of economic benefits that we are going to get in future, that we're going to have to pay tax on or anything like that. It has zero effect on future. So that's a permanent difference, not a temporary difference that we can fix with deferred tax. Okay, uploading homework questions. Okay, so I will tell you more about that. There's only, for IAS 12, there's only one question that you will upload. That's the last question, and you will only do that after the last IAS 12 lecture, and you'll upload it onto ClickUp before the next FRK 300 lecture. Okay, so you'll see in your question pack, question 9 does not have a solution, so that's a question that you have to do and submit it via ClickUp. The other questions you do not have to upload, but please go and work through them every day after the lecture. Okay, I think that's it. I think our time isn't any way up, and I think we have lost a few of our students already. Okay, so that's it. I'm now going to stop the recording. Thank you for joining me. It was fun. We'll do it again. Stu, did you follow? Do you understand everything about deferred tax? Glad to hear that. Okay, bye. See you soon. 5 new chat messages. Okay. Thank you for the lesson. Have a wonderful day. Oh, you're so sweet. Thank you. I can imagine the pressure. It's not that bad. I can handle pressure.